Welcome to How to Build and Fund Your Startup. I'm Andrew Gaule, and I'm very pleased to be with the great panel we've got here today. From CirculOil, we've got Alessandra and Steve, and we've got Anthony from Seed Legals, who's currently in Australia. So very pleased you could join us. So the format, we're going to have run around the panel to give perspectives on a particular circular economy venture and their journey in fundraising, which Steve's going to cover, and then Anthony's going to give a more sort of general overview on the challenges of building and funding sort of startups. Brief introduction to myself first. I've done over 20 years of working with large corporates with their innovation and venturing, been involved as a founder and done 2 of my previous businesses on Seed Legals and that as well. So I've got sort of history, and I've known Anthony for some time, and I've known Steve and Alessandra from work I did within BP and now supporting them in CirculOil. So very good to have old friends and contacts and that here. So that's myself. A quick hi from each of you first.
Hi. A brief introduction as well.
Yeah, go ahead, Alessandra, then we'll get into the meat. Yeah.
So, hi everyone. My name is Alessandra Scotese. My background is mainly in automotive. I've been working in Caterpillar and General Motors and Fiat, and then joined the Castrol, and where I met Steve. And recently we co-founded CirculOil, and I'm very excited to be here.
Thank you very much, Alessandra. Steve.
Good morning, good afternoon, everyone. I'm Steve Goodyear. I am CEO and founder of CirculOil. My background is I've just left BP, where I spent 25 years working there, mainly in the engineering automotive space. My last role there was as managing director of a company called Nexel, which has subsequently spun out into CirculOil. You'll hear more about that later.
Excellent. And Anthony, my friend, who's in Australia, and very good you could join us.
All right. So hello, my evenings are full up with calls, so I'm delighted to be chatting. I'm a night person. So hi, I'm Anthony. I'm founder and CEO at Seed Legals. I think many of the people on the call know of Seed Legals. And we are here to help on all things around your funding round. But of course, apart from just fundraising, you're also about finding co-founders, finding product market fit. So any questions you've got, please pop them in the chat, and I'll see which of those we can go through and use this as a forum, as a sort of peer self-help group to get answers to the most pressing questions on everyone's mind.
Excellent. Thank you all very much for that. And I say, as Anthony said, we want to make this quite a discussive sort of point. So we're going to try and limit ourselves to half an hour. As the panel, so we'll have plenty of time. If you can put your comments, questions in the chat, then we'll be able to get off. Feel free to, in the chat, introduce yourselves and put your LinkedIn or whatever and that as well, because this is all about connections. So Alessandra, we'd like you to kick off, please, and talk about the problem that CirculOil is addressing.
Yeah, sure. So thank you, Andrew, to giving us the opportunity to talk about our passion for circularity and the reuse of precious natural resources. Have we got the slides, Andrew? To put things into perspective, waste oils are the largest amount of liquid, non-water-based hazardous waste in the world. Yes, that's right. And from a 2018 study, we know that there are around 6 billion liters of waste oil produced each year, which is about 20 supertankers. Now, why waste oil is important? Well, improperly disposed used oil will make its way into the environment and contaminate soil and water. And even a small amount of waste oil can contaminate a large amount of fresh water. According to study published, only 1 liter of waste oil can contaminate up to 1 million liters of fresh water. However, waste oil aren't the bad guy here, because we know that there is a good thing about waste oil. They don't wear out, they don't degrade or lose their property. They just get dirty, and they can be remanufactured, what we call re-refined, indefinitely over and over again to be reused. And actually, for the environment, the re-refining process is more efficient than producing base stock from extracting oil from the ground. So we save energy by re-refining the waste oil and cleaning them. We also know that oil are precious, natural and limited resources on Earth, and we have to look after them, use them carefully. And by re-refining, we save resources from being extracted. We move from a linear economy of make, use and dispose to a circular economy of remanufacturing and reuse something precious, natural resources indefinitely. Unfortunately, we know that from studies, as of today, worldwide, around 60% of all the waste oil will be either burned or lost in the environment, which will cause more pollution and the depletion of natural resources. Now, what the legislator is doing about it? Well, the legislator are looking into this issue, and there are several legislation around the world, in particular in the UK, in the EU and the US, that are giving incentives to businesses to increase the rate of collection and re-refining of used oil. And it is expected that in the next 12 months, there will be imposed quantitative targets of collection and re-refining of waste oil in order to achieve bigger rate of collection. Now, our mission at CirculOil is to drive circularity and eliminate pollution from waste oil, because we believe that in a circular world, nothing should go to waste. So how do we do that? Well, we have engineered a patented cartridge technology and a lubrication system that allows waste oil to be collected and reprocessed in an effective and safe way. And how do we do this? We do this through a dedicated circular ecosystem, which will allow us to collect and refurbish and remanufacture 100% of all the waste oil to be then put back into the circle, into our customer. And we do this by using our dedicated CirculOil circular ecosystem. Now, Steve, I'll give Steve the next word in order to talk more about our technology.
Thank you, Alessandra.
Great, thanks, Alessandra. Really helpful. So, as Alessandra said, how is this possible? How is the possibility of being able to reuse this bad fluid? Well, it's all around the technology which Alessandra mentioned, which I've got an example of here. So this is what we call an oil cartridge called Fargo. And in here, this basically allows an internal combustion engine to be treated more like a printer in the way in which the fluid is changed. So the printer cartridge on a printer becomes the oil cartridge on an engine. It contains everything you need in there: oil, filter, everything. Now, there's two main benefits to this. The first one is it means that we can now start to recycle, reuse in the circular aspect the lubricant. That's the important bit. You know, at home today, we say we are recycling, but what are we actually doing? We're segregating our waste into plastics, into cardboards. That's what this technology allows us to do with the oil. It segregates the waste so that it can be reused. Without it, it's burned, and all of the things that Alessandra said. The other big benefit is it allows the oil change to be carried out really, really quickly. And if it's done really, really quickly and really easily, then it is actually done, because a lot of engines today are not serviced as they should be. So therefore, they are not running effectively, and therefore they are producing more CO2, therefore they're going to break down. Servicing, as we all know, is really important for the internal combustion engine. But you are talking, I'm sure you're thinking, yeah, but yeah, everything's going electric. Passenger cars, that may well be the inevitable outcome. Electrification is coming, which is why we are focusing on the off-highway market. So all of the engines which are used for agriculture, for construction, for mining, for ground care. All of these are going to be here for a long time to come, and all of them, because they're run so large times, they're run sometimes 20 hours a day, literally just changed over by the operator. They are producing a lot of pollution. They are not being maintained properly, which is why this is such a valid area. Now, as you can tell, I'm passionate about this. I've been passionate about this for a long time, which is why when BP decided that they wanted to not pursue this because of the area about passenger cars, I was very keen to bring this on board. But moving from BP, where we have every support you could possibly imagine, and heaven forbid, quite a bit more money than a startup has, I was desperate to understand how all of this bit works. So it was Andrew who came on board as my co-founder and introduced me to Seed Legals. And Seed Legals has actually enabled me to start to develop this business from something which was effectively a small department within BP into a standalone business. So it gave me the confidence to be able to do this. It enabled the angel investors, which we managed to secure quite quickly. Very, very trouble-free and very easy process for angel investment. Production of cap tables, etc., etc. So it really had that confidence to be able to move from a business with a product and a great deal of customer need and pull through to an operating business in the real world.
So, Steve, could you give us a little bit more detail about the investments you've raised and the SEIS and agreements that you've used within Seed Legals now? Because I know from previous sort of startups, it's quite a pain, and having that stuff taken off you. If you could give a bit more detail in that investment process and agreements, be great, so that we can build on it and get other people's questions.
I can certainly try. So, as I mentioned, we went through the process of initially bootstrapping, but we soon realized that we needed to move beyond bootstrapping into getting some investment. Now, along the way, there have been some advantages about being part of a large company, and I managed to pick up quite a few good contacts, of which we managed to make introductions to, and they said that they wanted to introduce. So the first step we went to was actually getting the company registered to SEIS, which made getting angel investment that much more attractive. We then managed to secure 4 angel investors, which gave us 150,000 initial angel investment, which sat below the SEIS threshold as far as the taxation benefits are concerned, and again enabled very heavily, which is why I say I'll try to answer these, because so much of this just happens. The system is very nice in that respect, so it just happened, but cap tables were produced, and we ended up with the 4 angel investors. Our current status is we are now, because we're SEIS registered, we are now EIS, and we are currently going through the same process again with EIS investment. We have managed to secure follow-on funding from all of our angels. In fact, they've increased their stake, which is fabulous. And we're out in the process at the moment about to start looking for the next round, again, EIS funding.
Good. Thank you very much to Alessandra and Steve, giving a real business, which is driving sustainable sort of type solutions. Anthony, can we move over to you, please? You see, hundreds of ventures going through similar sort of things. What's your experience now with Seed Legals?
All right, so thank you. So I think we've heard a common theme, and by the way, I'm going to go, Steve, with a joke. You've moved from big oil to small oil. I think the common theme we're seeing, and from the Nico's posts in the chat, which is there's generally a theme about going from an idea to a company. So nothing particular to do with seed legals, although I'm delighted that we help on that. But let's go through what I think is the formula. And the formula is about, finding product market fit, attracting investors, and the mechanics of doing a funding round. So let's start with Nico's question, which is essentially, when's the best time to fundraise? Is it before you've got users, or is it after you've got users? So let's take a step back and look at the journey. So the journey starts with 1 or 2 founders, typically sometimes 3 or more, get together in the pub when you went to pubs and have an idea, and you now get working on it. And initially you're funding it yourself. And our data shows that founders put in a median of £26,000 of their own money into the business first, because no investor is going to invest just on a PowerPoint. They want to see something. So the question is, should you just keep funding it yourself? And the answer is, as my business partner reminds me, you can't own more than 100% of your business. So at some point, it doesn't make sense for you to keep putting your own money in. You should get other people's money. And when's the right time to do that? Well, I think it's when typically you need more money than you could afford to put into the business yourself. And by not taking other money, you're rate limiting the business. So you're going, well, we can grow more slowly and we can hold off hiring some people. But no, if the goal is to grow as fast as possible to get to that product market fit, take over some space before someone else does, then anytime you are holding back intentionally, you're going to look back in some years and say, well, that was a squandered opportunity. So at the point that you think you found something that people want, and not having the money to scale it is holding it back, this is the time to find other people's money and do your first round. So now we come to Nico's rather interesting question, which is, should you raise before you go live or after you go live? And I think there's, the sort of trough of despair in between, and there are 2 good times to raise. So the first good time to raise is well before launch, when people are buying into the team, the idea, the vision. There's nothing tangible yet. We're going to change the world with our blockchain-based something. No one knows if it's going to work, but they're passionate. They see your passion. They want to be part of the dream, and they will invest. And obviously, they're going to invest small amounts at a lower valuation because they need to get some chunk of the business for their investment, because the risks are high. So that's your classic, 150K, 200K, SEIS, EIS round. It might even be a friends and family round of 50K or 70K before that. So that's the well before launch. The other good time to launch, great time to launch, is to get funding, is post-launch, when you have traction. And essentially you've opened the box, and now you've got either, if it's a social network, you've got viral growth on users, or if you've got a SaaS product, you've got sales, or if a physical product, you've got increasing sales. And essentially it's that dream that in your business plan, you've got month-on-month growth. And if you've got great month-on-month growth, eventually you don't need to go look for investors, they will find you. But the problem is the gap in between, which is you've raised money, you've spent money, you've built something, you launch, and only in Hollywood dreams, or very occasionally, does it go crazy when you've launched and thousands of people come. Almost inevitably, 4 people arrive, 3 of them friends of yours and 1 random person who picked the wrong website. And why? Because it's really hard. You have to find customers afterwards, and you have to start marketing and generate content and do events and get out there. And the problem is, for an investor, the fact that you've launched, investors are often a bit naive to the way things work. They see the growth of Clubhouse or Snap or something like that and believe all companies will grow like that. And when they go, how many users do you have? And you go, ooh, 27. There's that crestfallen look, waiting for how many zeros you're going to add to it. And you go, no, it's just 27. So that's really the least good time to raise money. So what you ideally want to do is to be able to raise enough beforehand that it will carry you through that launch period so that you can have gotten it live. You can now do some sales and marketing and now get users to get to the good place to raise again. So that was your sort of funding life cycle, if you can do it. Now, of course, this is a challenge because when you raise, it almost always works that the amount you've raised is kind of going to run out about the time you've launched. Otherwise, you would have done more development and launched a bit later. So you're going to have to try to manufacture as much desire and oomph when you launch as possible. So to get back to Nico's question in the chat, which is, should you wait until you have paid users to raise, probably your second round, because you had to have done something to get there first, or should you raise beforehand? And the question really is, once you have paid users, will investors now look at it in terms of the reality rather than the dream and the hype and go, okay, great, you're doing 5K a month? I think the answer in this case is to look at it a little bit differently, which is investors will invest different size amounts on a different risk basis as you progress in the journey. And actually having paid users is a huge milestone and takes you to the next level where you've now moved past the investors who will only be filtered by those who will invest on the dream. You've now proved that you've got at least a modest amount, and in theory, you could be raising money to spend more on advertising to get more users. And that's really the difference between startup and scale up. So I think, Nico, the short answer to your question is, if you can now prove to investors, yes, you've only got a small number of users, but you've proved the point, you're now showing the retention, the stickiness, the custom acquisition cost, which you've now got data on, to the best you can figure out the lifetime value. And now it's just a question of priming the pump. And, were you to have a decent number of users, that's actually your Series A round, where you're going to have a VC giving you substantial amounts of money to take what you've built and get it out to the world. So that was the 101 on, startups, I guess. And now, Andrew, back to you, and I'll have a look at more questions in the chat.
Yeah, no, excellent. Thanks, Anthony. A really good overview there, from moving from friends and family and the idea through to scaling up. One of the questions that's come through, be great to get a perspective on, is about valuations. And some people have been posting here saying about some of the great content you've already got on Seed Legals, which I often refer to, around those principles about valuations and what to pay the founders and sort of stuff like that. But if you could answer that specific one about valuation, the proposition for valuation, that'd be great.
Yeah, so I thought I had valuations all worked out, and then I see some crazy US valuations and even some crazy local ones, and I'm wondering if the rules have changed, or the rules have changed for just a few people. But the somewhat facetious kind of view of valuations goes something like this. A couple of founders get together, have an idea, valuation's 300K. All right, you've built something, a prototype, 500K. You've got it out there in the App Store and you've got some users. All right, 800K to £1 million. You've got a decent amount of traffic, 1.5 million or £2 million. You've got revenue, £2 million plus. And once you've got some revenue north of about £20,000 a month, then perhaps the valuation is a function of revenue. And the higher the revenue and the later stage round, the more it moves from, we like you, we have no idea if it's going to work or not, okay, £1 million valuation, through to you're doing £1 million a month in revenue, that's 12 million a year. We apply typically a rough benchmark might be a 10x annual revenue to get a valuation. So if you were doing £1 million a month in revenue, that might be a £120 million valuation. Or starting from the earlier stage, doing £20,000 a month, that's what, £240,000 a year, 2.5 million valuation. So once you've gotten to revenue, then you've got a benchmark. And the 10x annual revenue is ready for SaaS online businesses. If you're selling oil, the multiple will be different because it's a physical good. But the 10x might also be based on a 3 times year-on-year growth. If you're growing way faster than that, you'll command a higher multiple. And if it's much less than that, if your cheese shop has been doing the same revenue for the last 3 years, it's increasing slightly, it's unlikely you'll raise a 10x annual revenue. So I think that is the starting point. What makes me mildly envious is when I see valuations in the US that have at least 1 extra zero on them. Sometimes blockchain gets you another zero, or sometimes makes it much harder to get funded. I was really intrigued, by the way. I went to a blockchain event a couple of weeks ago, and it turned out I was expecting to be the only guy in the room who'd ever done a proper fundraising round, not a Bitcoin one. And it turned out a good fraction of the companies were all on seed legals. So it seems the secret of blockchain businesses is you start by doing your 150K SEIS round to build the future Web3 blockchain-based world. So that was a slight diversion on the answer. So I think the last thing, by the way, is with fundraising is the amount of dilution. And here you may find in the bad old days, investors would want 30% of your business, or you'd have a well-meaning but naive family member who would invest 20K in your business for 30%, thinking, my cousin has only been doing this for a few weekends. How could it possibly be worth more than £100,000? And if you give away too much equity or sell too much equity too early on, you become uninvestable later, because later stage investors see the founders are now minority shareholders in their own businesses. If you've got 3 founders sharing even 50% of the equity, they're down to 15% each. So take care to not dilute by more than 15, 20% ideally in your earlier rounds. And then there's one last bit of advice perhaps from me, which is, of course, everyone would love to raise £500,000. I think all startups go like this, which is we have to do a business plan. Well, we're going to need 2 developers, we're going to need a marketing person, a salesperson, a data person, the founders want to be paid as well, a social media person, a designer. That's like 8 people. Assume 50K each, so that's 400K for a year. Let's raise for 18 months. That's 600K. Great, we need 600K to raise. But it's hard to find 600K super early on. So there's a gap between your idealized 8-person team versus what you can find initially. And that then leads to this dilemma of, do you, if this is time and this is the amount you want to raise, do you do a lot of kissing of frogs and dating of the perfect investor to raise the full amount? Or do you go to plan B, which is say, I'm not going to sit around for months waiting for the perfect investor to come along, and I'll raise small amounts piece by piece, because I didn't need the 500 or 600K today. I only needed 50K today to get started with an outsourced web agency or developer and so on. So that's where seed fasts come in to raise ahead of a round. And then you may do a round and then you may top up. And I think agile fundraising is the new way.
Yeah. You did an excellent video on that recently, Anthony, that I sort of saw. So we'll repost that. That was really good on that agile bit. And I've used that instant invest seed fast and that in the past. Got a question here, which I think I'll put to Steve, and then maybe you could follow up, Anthony, regarding to employee sweat equity, because I know that CirculOil did that first. So the question from Michelle is, what's the best way to bring on initial employees via sweat equity, via employee stock option schemes? I have a few friends or peers who want to do around 1 day per week and happy with sweat equity. My research do this and ring-fenced employees. Steve, could you give the sharp end view about some of the founders in general terms? You don't have to go into the specifics on how it's working within CirculOil, and Anthony, you could follow up. And then Anthony, maybe you could look at the next question, which is around, I heard investors' money converts into shares in 6 months' time during the SEIS phase. Maybe you could prepare yourself for that question next. But Steve. employees and sweat equity?
Yeah, certainly. Happy to give you what we did, and it's working very well. Whether it's the ideal answer, I don't know, because I'm sure everyone's got different circumstances. But the way that we did it in CirculOil is that we've actually got a team of 6 co-founders, and each one of those was awarded with a small percentage of equity, which was vested over a period of 2 years. And that vestment, or that vested initial, was, I think there was half of that vested upfront, and then the final half was then vested based on performance. So we used a performance contract with an expectation of how much work was going to get done by each person, worked out at around about a day, day and a half. We come into the end of that 2-year period now, and most people are getting that equity that they did because it's worked very, very well. The advantage of this, of course, is that not only do I get, am I able to let people get involved who want to be involved, but I'm also very rewarded by the fact that their contribution is showing the increment in our valuation. So our initial valuation has gone up between SEIS and EIS, and obviously everybody's interest has also gone up as well, which is really rewarding for everybody. So that's how we've done it.
Yeah, and my experience from a previous venture that we used seed legals for in the retail sector, there were 3 of us as co-founders. One of the co-founders really felt, and we all mutually felt, it wasn't sort of working out. So the founders' agreements that we'd done from seed legals were all very fit for purpose there. That the 3-year vesting period, we all were able to part amicably, and that in that sort of scenario. Anything to add to that scenario, Anthony?
Yeah, so it's a fascinating point. So I think when you give people equity, you might put them into 2 categories. Category 1 is essentially you're giving them equity instead of giving them money, because you just don't have the money and they're being paid in equity. And the other category might be an employee who's actually paid around market rate, but being incentivized with some share options afterwards. And I think you should consider them separately, because you've got a slightly different moral obligation. And if it's somebody you're paying essentially market rate, then you can happily top them up with equity. It's a fun gamified experience. If their equity has value, then that's great. If it doesn't, if they leave early and it's not vested and they lose it, that was fine. It was a nice, fun thing to be had that could have given them value, but they can still pay their rent. On the other hand, I'm always slightly concerned that you might find somebody who doesn't understand the risks of a startup and chooses to not get paid money. Maybe you don't have any money to pay them, and they begin working and actually are now unable to pay their rent, hoping that they will be in the money and millionaires from the equity later. So I think, firstly, have a frank discussion with the person going, listen, if it's a day a week and you've got another day job, this is fine. It's a nice win-win. Hopefully things will work out brilliantly. If it doesn't, you're not, dependent for your rent on these share options. The second thing is, how many options should you give the person? And it's really difficult to work out, because the person might go, oh, I'd like 2% of the company. And you might go, well, that's a crazy number. I'm thinking 0.2%. So how do you figure out the amount? And here, the trick that I like to use is to equate it in a pound value. So you may say, let's say hypothetically, my valuation is £1 million right now. If you're doing a day a week for, let's say, the next year at no money, and paying you essentially with share options instead. So maybe that's a day a week, £10,000. £10,000, £1 million valuation. That's 1% of the business in share options that I will give you, and it will vest over 1 year. You might say 2% over 2 years and so on, but never give somebody their entire options up front, in the same way you would never give them their entire annual salary on January the 1st. You'd promise them 1%, and then that would vest over time. And you can also choose to give them shares which means you have to allocate the shares on Companies House, or share options, which gives them the right to the shares later. Share options is the safer way to go because you don't have tax issues until they exercise later. You don't have them as voting shareholders and so on. So there are many advantages to share options instead of shares. The only time typically you would give someone shares is really early on in the company, particularly for founders who all need to have shares. Otherwise, if they don't, the investors will essentially own the business. So that was your 101 on the number of options and instead of salary or topping up salary.
Excellent, great. So the other question that came through, Anthony, for you here was around the, did you see it here from Director? I heard that investors' money converts into shares in 6 months' time during the SEIS phase. Question, what's the start period of the 6-month limit? Date you approve your HMRC, date to receive the funds, none of the above. If you could answer that, and I could ask Steve to prepare, what are you going to spend your seed funding on? So Anthony first, if you can answer that question, if you understand that question.
Yes, absolutely. So once upon a time, there was no such thing as an advanced subscription agreement. Essentially, an investor would give you money and you would give them shares. You know, on the day that they gave you money, you would give them shares. That was called a funding round. And then people went, well, actually, I need to get some money ahead of the round. And convertible loan notes were created, which says, I will give you money now and it will convert into shares later. But a convertible loan note doesn't qualify for SEIS because the money can be repaid, it can get interest. So another system was invented called an advanced subscription agreement. And it says, I will give you money now and you will give me shares later. And we productize that on Seed Legals, and we call that a seed fast, and they're insanely popular. But HMRC said, oh, wait, an investment is only when money is paid and you get shares fairly soon afterwards. If you pay money and a huge amount of time goes by before you get shares, we're going to call that a loan, not an investment. So HMRC decided that in the case that an investor gives money before a round, putting aside any seed fast, if they just happen to send you money well before your round, if more than about 3 months goes by, you risk HMRC deciding it's a loan and not an investment, and the investor won't be able to qualify for SEIS or EIS. I've never actually seen them disapply it for that reason, but in theory, they could. But if you have a seed fast or an advanced subscription agreement, they then allow up to 6 months beforehand for the investor to provide money before it converts into shares. This used to be 12 months. They've shortened to 6, which makes many people's lives a bit tougher because you have the shorter period to get money before a round until you can do a round, but them's the breaks. And so that's the 6-month period that you refer to. And the time is measured from essentially when the seed fast is signed, which is meant to be the time that the investor sends money, through to when shares are issued in the funding round later. That's the 6-month period.
Thank you, Anthony. And we had a question, Steve, I think I'll put to you about a question, what do you spend your seed funding and that on? So maybe you could explain the different pots of money you've had and what your plans are.
Yeah, happy to do that. I'd also be interested in Anthony's answer to the same question because this is all new to me. So I can tell you what we did, but I'd be interested to know how other people did it as well. So when we received our first seed funding, which, as I said, was through our angels in SEIS, the intent was that we were going to be using it heavily to secure the robustness of the business. And for that, it meant securing the intellectual property, which was being moved over from BP over to our company, and start to build the foundations of the company, getting it ready to actually start to sell the product. So securing the business, bringing in all the tools. You know, bear in mind, this is not a piece of software, this is hardware. So there is quite a lot of upfront cost which is required in order to start moving. And then Also further costs when you need to scale. It's the big disadvantage about doing hardware rather than software. In truth, the money we had went a lot further than we ever thought it would. So we did manage to secure the team, we managed to secure the website, we managed to get everything working. Our legal fees, unbelievably, were not as high as everyone thought they would be. So we managed to save a bit of money here and there, and actually managed to get to market on our initial seed funding. And I'm pleased to say we have now started to compensate some of the employees from our seed funding as well, which is really good, because I mentioned earlier that other than Andrew and I, we were planning to be spending significant, I was full-time, obviously, bootstrapping it, living off my redundancy as well. But my co-founders were only supposed to be doing 1 day a week. The workload was a lot more than that for some of them. So it was only right that when we had funds available, we started to pay them. So we were able from our seed funding to do that as well. So it went further than I thought.
Good. Your perspectives, Anthony, on what people spend their money on?
Sure. So I guess, Steve, you were probably a bit unusual. You know, you went to your investors and well, first we're going to use your money to build a refinery. And then if there's any left over, we'll work on the software piece. No, but jokes aside, you know, the use of funds before you've got product market fit should be laser focused on only those things that are necessary to determine whether you are going to have a product that people want or not. So things that you shouldn't be spending money on should be massive server scalability, which many people think, what if the doors open and thousands of people come? We have to have massive Amazon instances and multi-homed and multi-zoned and so on. Don't do that yet, because actually only 12 people will arrive when you open the door. And if the server goes down, actually that's the time to go and build more servers. The second thing to not spend money on is, and this is really difficult, and I've been there and done that before, which is on paid advertising, pay-per-click, Facebook ads, and so on. So the challenge is, sometimes I'll see in a pitch deck use of funds. Some of it, of course, is the team and development, as you would expect. But now, you know, at some point you have to get users. And when is the point that you're going to start spending money on Facebook advertising? And if you spend money too soon, what you'll have is you'll have a blip of incoming users, and then the pot will run dry. You'll have used up all your money. And now you've got the worst of all worlds, which is you saw a nice amount of traction and you were probably going to fundraise at that point, but the fundraising took longer than the money lasted. And now it's all back down again. And you've proved that, in fact, you didn't have a retention of users, you were buying users. And if it's a leaky bucket, you're going to keep on putting money and it's all going to come out and go to Mr. Zuckerberg, and he's got enough. You don't need to give him more. So what you want to try to do is use whatever free methods you can use to get users. So all those lovely articles on Seed Legals were written by myself and colleagues way back when we had no money. And so for me, content marketing is king, which is finding out, you know, if you've got a tea company, write articles on the perfect boiling points for tea and how it's made and produced. And, you know, you can be the thought leader. Google will find you. You'll find others coming to you. You'll find it referenced. So in the initial stages, as much content marketing as you can do, and then try to get your, whichever way you can use, there are no easy shortcuts, to try and spread the word before you spend money on paid. And the point to spend money on paid advertising is when you have a product you can sell and you've got ideally product market fit and your lifetime value of a user is greater than your customer acquisition cost. And everything in your startup journey is to get to that point. And that's when you go and talk to the likes of Index Ventures and so on to really scale that. So, you know, the things to avoid, and it's really, really difficult to have the discipline to avoid it, is if you are not spending money on paid marketing, advertising, where are these users going to come from? But if you go too early, it's easy enough to frit away all those, you know, relatively modest SEIS funds, and then you're left without users and without funds.
Great, thank you, Anthony. Yeah, I've seen some comments here about do seed legals produce term sheets and sort of stuff. I'll just give a little bit of experience from my use of seed legals. I've been on both sides. I've done now 3 businesses through seed legals in terms of getting the entities set up, doing the initial, getting the approval from HMRC, which is straightforward and that within seed legals, doing the term sheet. I've also been an angel investor through Henley Business Angels a number of times and that as well. And we've seen it when there's a traditional lawyer who's having to send over documents that you've got to read all of them through. Whereas on seed legals, you can sort of see which terms have been selected from some good standard best practice market sort of practice sort of type options. And then when you're as a founder setting those up and you're sending them to the investor, it's pretty transparent and that between you both and where the documents and that are. And I had a conversation earlier today with some potential investors and they said, yeah, like the initial pitch, can you send us an NDA? The NDAs in seed legals, part of the package, go in, just fill out 3 simple boxes, put their address in, say how many years it's going to last for, send it off and get a electronic sort of signature back and you get notified. So, you know, and EMI for a couple of the business I've been involved in, we've set those up as well. Again, framework, standard terms, easily understood by you as the founders and by the people you're sharing the documents and that with. So, you know, I found it, you know, an excellent way as an investor and as a founder. Anything I've missed out, Anthony? I'm making your head swell, but I am really pleased with the
and that's very kind, and I'm delighted at the seed legals plugs. But actually, when we started seed legals, my thought was that people were looking for legal documents, and it turns out actually no one's really. You don't get up in the morning and go, I would love a good contract. You go, I would love some investment, or I need to hire somebody. So in fact, what I've found is it's essentially the things we're all discussing on the call here, which is how do I build my business? And this, I think, is a bit that lawyers often miss, which is the information being shared here is, when should I fundraise? What valuation? Should I raise before, around, or after? Should I wait until I've got product market fit? What should I spend money on? And by the way, can you make some agreements for me? So the agreements are just a byproduct of what you would like to do, and what you'd like to do is based on essentially learning as founders what the formula is that investors are looking for, what's market standard, and then data that comes with that. So actually, at the end of it, the machine that makes the legal documents, although that's ultimately the business, is almost a side piece of, essentially forums like this, which is to, for those who are new to this, understand the way that people raise money, the way that founders create businesses, and maybe what are the good and less good things to do as part of that journey, and how to tweak things when the journey doesn't match the way you'd want. So, for example, the founder fallouts or something like that, how do you plan for that? And I think the last thing, which is, hopefully things work well, but perturbations come up in the force field, founders split up and so on. And when people call us at Seed Legals, I like to think that the legal documents are like the instruction manual for your car. Something's gone wrong with the car, it's stuck at the side of the road. You take out the manual, the shareholders agreement or the articles of the founder agreement, and it should tell you what to do next. And actually, that's the hallmark of a good document, which is, founders are split up. Well, page 3, founders split up. It's called deemed transfer, but it's a bit boring, but that's the section. And now you go, oh, you've been here for 2 years, so this needs to happen. And I feel bad if, somebody opens the playbook and we don't have the answer, but it's really all about enabling you with the knowledge and data to A, know what to do, hopefully, and B, convince investors that you know what to do so that they give you some money as well.
Great. So look, we've got just about 10 minutes left. So I'm going to make sure if you've got any more questions, please put them into the chat or raise your hand. We are recording today's session, and we will be putting that on the Aimava website and on the podcasts. And for previous resources, Anthony said he's done some great content in the past and that with me. We've done podcasts going back, one about 5 years ago and one just about a year ago, where we talked about how business were going through COVID, etc. So we will be happy to share those content and happy to, if you've got any questions, reach out to us directly in that as well. So anybody have any other questions, or have I missed any questions now in the chat? It'd be great if people would raise their hand or speak out. So
there was a total addressable market question from David.
Go ahead if you got a view on that.
David, over to you.
Please feel free to unmute yourself.
Yeah, cool. Just my question really. So the total available market, I got your valuation points at the start, and I was just wondering how much a good total available market size affects valuation. And obviously this would be at the stage of kind of pre-seed, maybe pre-seed seed. Got initial paying customers, you've got probably some proof of the revenue per customer and some justifications as to the balance of the revenue per customer. And for me, in a new market, I've extrapolated the number of potential customers and just times one by the other. And it's a good size number, but I'm wondering how much that can play into a valuation at such an early stage.
Okay, great question. So I think there might be two parts to it. One is, does the total addressable market, the size of your potential market, have anything to do with your valuation? And number two, what's the story that investors want to hear? So firstly, I don't think the size of the market relates to your valuation at all. I mean, the size of the market could be, Facebook's social media, but it doesn't matter how large it is. If it's a very small total market, then that's going to limit what you can do. If it's a large market, your investors will just go, it doesn't matter that the social media market is $1 trillion a year. You don't own it, somebody else does. But so I think the second part is the more pertinent one, which is, what is an investor looking for? And here, I think this is valuable info for those on the call who haven't seen it, but angel investors and VCs see the world in very different ways. And angel investors would love to get a 5x or a 10x return on investment in 3 to 5 years. The bank's going to give you 0% right now. If you could, with a reasonable degree of assurance, maybe a 30% chance you'll get a 10x return on investment, that was quite a good deal. Couple that with SEIS and EIS, now you're rocking. A VC, on the other hand, has a different formula, and they raise a ton of money, let's say 100 million pounds. They're going to invest it in, let's say, 10 or 20 startups, and they know that some of them will go out of business, some of them will make a 3x return, and they're looking for each of the investments to what's called return the fund, be a 50 times or 100 times return on investment. So each investment that a VC is looking to make, they're looking for it to be a unicorn. And the problem with that is they're looking for the company to be hyper growth and have a huge valuation and a huge addressable market. And if it's not them, then they'll go, well, this sounds like a hobby business. It's fantastic. Maybe you'll sell in a few years for 100 million, but it's just not us. And when you go home and talk to your spouse and go, well, what would you say if we were to sell for 100 million? Is that a failure? And they would go, actually, that's quite good. So your challenge is, if you can find a giant addressable market and show numbers that get you to unicorn status, then that's interesting for VCs. If you can't, it may mean that you are going to not limit your attractiveness to angels, that's fine, and you'll get your initial SEIS, EIS angel investment, but you'll potentially struggle to reinvent the total addressable market and reinvent it to be more visionary when you go talk to VCs later. So maybe the brief takeaway point from all of this is, in your early round, when you talk to angel investors, although you think that they want to hear that you're building a B2C product, a B2B, you're putting on the blockchain, you've got a Tableau data thing, you're going to sell data. All of these sound attractive, but actually all of them are you spending more and more money that you don't have revenue for yet. So when you talk to angels, in my view, it's all about showing clarity of one proposition. We're just going to do a B2C. And then once we've got that and we've got revenue, then we're going to build out these other things afterwards. If you suggest you're going to be doing a lot, an angel investor is just going to go, you're going to spend more money, it's going to go sooner. However, when you go talk to a VC later, you still want the clarity of your go-to-market proposition, but you also want to embellish it. You want to show a bigger picture vision that it's going to go way beyond this early stage, that it's going to be a global play, it's going to be beyond the blockchain or whatever it is. So the VC sees that it fits their model. So all of which you say, I think it's a sort of left and right brain approach to take, and really creating a proposition without, of course, distorting the truth. You can embellish and so on as needed, and you can show future plans or not future plans as needed, depending on your investor audience.
Great. Thank you very much, Anthony, for that. There was a question around validity periods for SEIS, EIS advanced subscription received from HMRC. Is there some sort of time limit on those, Anthony?
No, once you've got your advanced assurance, it basically lasts forever. Remember that you can only offer SEIS for 2 years from when you first started trading. It's not from when you incorporated, when you started trading. But if you got your advanced assurance and some years have gone by, no problem. I mean, the assumption, of course, is the business is substantially the same as the one you got your advanced assurance on, but there's no ticking clock on that.
Great. So thank you very much. So we've come to the end of our hour. It's late in the evening for Anthony, and I'm sure he's still got some more calls to do from Sydney. So I'm going to suggest we wrap up here. We will be posting this, as I said, on our video and podcast channels. So we will circulate to all the people who subscribed on that today. So just like to go around and thank Alessandra. Thank you very much for your insights on the circular economy and the venture.
Thank you very much. I've actually learned a lot today, so it's been a pleasure.
Good, thank you. And Steve, thank you for sharing your journey of being the founder and going through the financing.
You're very welcome. I enjoyed it. Thank you.
And Anthony, my friend, thank you very much again. You were a great contributor over the years, and we're really pleased to be, I've been pleased to be working with the Seed Legal team. So, and thanks so much for your insights and that all again. Thank you very much.
Thank you. And by the way, if you've got any questions, you can reach me, anthony@seedlegals.com, or drop me a note on LinkedIn.
Excellent. That's the same for all of us. We're very pleased to connect. So thank you all very much. Enjoy the rest of the day, all of you. Bye for now.
Thank you.
Thanks.
Thank you.
Bye.
Bye.